Hello, everybody. This is Crypto Rookies once again for the session 3 of our entire series about how to make and preserve wealth into the cryptocurrency industry. Hello, Jane. How are you?
Hi, Patrick. All good. Really happy to be back and continue with our topics.
So today, we wanted to maybe discuss tokenomics again, but this time put a larger focus on the token allocation and the vesting and all those details when there's pre-sales and so on, because that's a big chunk of what often goes wrong into the tokenomic itself. There's a specific project I wanted to show. So this is a project I saw recently, and I thought the tokenomic was not so bad. Again, I would do tokenomic where there's no pre-minted token allocation. Personally, I would prefer that, but in this case, they do have a pre-minted token allocation, investing, and all that stuff. But compared to a lot of other projects, I think they didn't do such a bad job. So that's why I wanted to review it with you. So this project is called Faber, and it's something related to social media. I didn't read the entire white paper and all that stuff, but I focused a bit more on the tokenomic aspect. You looked into the project a little bit as well, right?
I did, and I think it's quite interesting. It's like a social media platform, but it would be more into giving messages between each other, commenting, and then, for example, if you do choose some of the topics that you want to talk about and you write a small article, and then some of the comments that go afterwards, you communicate, and then they would gonna have some different subscriptions as well in the future, so that your article that you wrote will be on the upper stages, I would say. That's pretty interesting, and I think people will get really into that. It's not that hard to understand because it's a normal social media, but I think they're going to involve many things inside. As for example, they're going to have NFTs and some of the things that people cannot do in Web2. And I think that would be a really interesting project.
I think I haven't taken too much of a deep look at the project itself, but let's take a look at the tokenomics and see. At some point, I'll probably make a review of the rest of the project. But cool. All right. So when you go look at the website of a project, you often have a section for either a light paper or white paper. It's not always the case, but often you should be able to find that information. And then the tokenomics, sometimes it's very different. But if you ever see some kind of wheel like that, and then you have the team as part of the supply, the community, it's a similar pattern with a lot of them. So the first thing we can take a look is that, for example, in this case, advisors, 3% of the supply is allocated to them. Meanwhile, the funding team and the dev team have 18. So to me, it's not so bad, because what I don't like is when I see advisors with 5% of the supply and then the team 10%. So the team is there full time, investing their assets to make the project work. Meanwhile, the advisors may come in here and there. Are they really going to provide that much help and support to the project to make it a success? To me, it's always a bit unclear, that part. So I don't like when I see advisors which are like a massive chunk of the supply versus the team, small in comparison. So this 18 versus 3, I think it's not so bad. And to give you a comparison, if you look at tech companies like non-Web3, like just pure startup techs, typically speaking, advisors get, I don't know, less than 1%.
Percentage.
And I think the funding team at that stage, they have 80 or 90% of the supply of the equity itself. So why is it so different in tech versus Web3? To me, again, I'm not a big fan of seeing advisors with too much. And technically speaking, if it's an advisor that is worth something, you want them as an advisor because they achieved some sort of success in the past. They have some expertise that are really relevant. If they have that and they have been in the industry for long enough, they should have the wealth to just buy the token early on. Why they don't act as an angel investor? Why are you giving them free money? If it's someone, an advisor that has $100 million of crypto, why would you give them, I don't know, $50,000 worth of crypto? To me, it just doesn't make that much sense that you would want to give them free money. And in some case, it's a large chunk of the supply versus what the team gets. So I'm never a big fan of that.
But does it mean, for example, if they have 10 advisors, so they split those 3% per each advisor in the team?
Yeah, they do. But again, to me, if they are really worthwhile as advisors, why? And if they've been in the industry for 5 years or more, how come they cannot afford to buy into the project with their own money? It should be trivial money for them. Are they never acting as angel investor again? So that the funding team, 18%. In this case, it's a little bit higher than other projects I've seen, but it's not out of ordinary. I think it's fine the way it is. And at that point, it's more a matter of what's the vesting schedule like. And maybe we can jump to the vesting and come back to the rest of the categories. But I think in this case, that advisors, they have 3%. They cannot sell in the first year because that's the cliff of 12 months. And after that, it's 36 months of linear vesting. The 36 months, it's not so bad.
So the cliff, it means it's a timing when you cannot sell and you cannot do anything with the tokens that you have.
Exactly. So in this case, that means that the advisors, they will only be able to sell all of their token by the 4th year, because it's the first 12 months they cannot sell anything. And after that, there's 3 years of vesting that they can sell along the way, but they never get all their token at once. You want vesting that is longer usually.
But usually it's, for example, a certain percentage of tokens that you hold during those 36 months, like you can sell them, but with a certain percentage that they will allow you to do.
Yeah, but that's the thing. In this case, a cliff of 12 months means you have no token to sell in the first 12 months. And after the first year, then every day, because it's a linear vesting, I don't know if it's every day in this case, but you have a linear vesting. So every month or every day, you'll get a percentage of your token that you can sell. You'll be finished selling or having them unlocked on the 4th year.
But don't you think it's might be a lot having 4 years?
Yeah, but it's in the tech industry, Facebook, they went IPO in, is it 8 years or 10 years later? Like the people who have equity, they could not sell until then. You're there for the long run. Like a tech business should last a long time. Crypto business, if they expect that the project will be finished and dead after 4 years, I'm not a fan of that kind of pattern. For me, when I see 2 years or 1 year vesting, I'm not a big fan. I prefer that people are locked in for long, like the team and the people who get into the project. I would prefer that they are there for the long haul. Like in 5 years, it's not bad, but yeah. If Mark Zuckerberg would have been gone from Facebook after 5 years, would Facebook have achieved as much? I don't know. Maybe yes, maybe no. In tech, it takes a long time to get things started, so it should be long in my opinion.
But you know more or less the average useful life of token, at least in the market, what the trend usually is.
A lot of projects, it's 1 or 2 years vesting. I really don't like that. Here, 4 years, I think it's not so bad. And I think in this particular case, I've seen a lot of other projects also that the moment the token is created and listed on an exchange, there's often like the team or advisors get 10 or 15% unlock at TGE. When you see that, normally I calculate how much potential selling volume, like if everybody that get the unlock on the first day sell, what is the damage that is going to do in terms of selling pressure? Because if you're able to know how much stablecoin or token in the liquidity pool, let's say it's on a decentralized exchange, you have 2 pairs of tokens that are together in a liquidity pool. If you know how much will be there in the first day, let's say that it's $500,000, but then you have 5%, 15% unlock at TGE in various category of people who got the token for free or at a massive discount, the likelihood that they'll sell on day 1 is high. And then if in combined, they like with the price of the listing, they have like for $2 million, you're gonna get crushed most likely. Unless there's massive market demand, the token price will go very low. So that's why I'm always concerned about that thing when I see token that unlock at TGE from the team advisors or some other partners or like just the early stage VC that went in at a massive discount. In this case, if we look back at the table, I believe they had the pre-sale, private sale, 18% of the supply was sold. And in this case, I didn't look entirely, but you would want to know at what price those tokens were sold in comparison to what will be the price on the listing itself.
But who usually buy the private sale? It's before the token has been released, right?
Exactly. And it's in some cases, it could be a few months before it happens. Sometimes it's a few years before it happens. But I've seen projects that between the time the private sale happened, like early stage investors get 10 times their investment by the time they list their token. And sometimes this happened in 1 year. If you get 10 times your investment in 1 year, are you going to sell if you have any amount of token that unlock on day 1? You will, because you get 10 times your investment. You just sell 10% and you recovered your initial investment, and then you still have 90% of capital to sell on the way. And that's the thing. So I'm really concerned when I see massive unlock TGE itself. And I know from an investor perspective, they want to negotiate that. And a lot of projects are afraid to say no, but you're shooting yourself in the foot if your early stage investor get too much of a large discount and they can sell on day 1. Typically speaking, like if you talk to the tech investors, they invest for the next 5 to 10 years. They might not get any exit in that time frame. So in the crypto industry, when you see investors wanting their exit in a year or 2 years, I find you're shooting yourself in the foot as a project, because it's a lot to absorb by buyers once you launch.
And about the partnerships, is it something common that they usually have within the project?
I would say it's okay. As long as it's a good partnership, it's fine. But it comes down to most projects have more than 90% of their community that are speculators, not real users. So if you make a partnership with another Web3 company and what they bring you is speculators, that's not as great. Unless it's a partnership that is more tech oriented. But if it's a partnership that is about onboarding more potential customers, but they are speculators, maybe I would not do it. There's a possibility it's a partnership with a Web2 company, like a company that has nothing to do with crypto. For example, Solana had the deal recently with Visa. If they were to give a percentage of their supply to Visa, I would not be unhappy, I would say. Depending on the terms, I would be fine. So the other thing is that here you see community and ecosystem treasury. A lot of projects are a bit fuzzy how those tokens are treated because technically speaking, they are under the control of the team. So in this case, the team control the team token to a certain extent, maybe the advisor token, the partnership, and the community and the additional airdrop. So they have a lot of control over what decisions are taken and how those tokens are released and all that stuff. Sometimes it's concerning to see a large amount of token in the treasury and community, but it depends how they deal with that. For example, if you have 27.7% of your supply that is there, but your intention is to do your own market making, and then you do it in a way that protect your token economy, I'm perfectly fine with that, and I would actually favor it. But if it's a large amount of token and that enable maybe the team to do a rug pull, that's really scary. Because maybe they will, if there's no vesting, they could take 18% of the token plus 27% and then sell everything maybe a few days after launch or a few weeks after launch. That's what people refer to a rug pull. So it's a big concern because there's lots of those scams happening. Okay, so in this case, that what I thought was good also, here, the community reward, it's a large amount of token, but it's going to be vesting gradually over 5 years. So my question in this case is that, is the project after 5 years sustainable, that you don't need to reward community? Because are the community going to be there because of that extra reward or not? So it depends how it's implemented. 5 years, it's not so bad. I've seen project that it's in 2 years and it's gone. But my question is, what happened after 5 years? Will there be users that want to come and use the project even if there's no more community reward? That's what you should question, basically.
For Treasury in the ecosystem, why on the vesting schedule there is no timeline at all?
Yeah, but that's why the console in this case might be a DAO. So it's not just the team that has control, potentially. It might be a DAO with community members or investors. So it depends how it's implemented again. If they are doing market making with it, I would be totally happy if they have the full 7% available at the beginning to manage correctly. It depends on, and I think I never mentioned that to you, but my current startup, it's about doing market making for project, but doing it with them internally. And I would recommend project to have a large treasury in order to sell the token as market adoption is going, to build the collateral so that you can use that collateral to buy back your token if the price starts to crash. So that's like a hybrid how a stablecoin works versus an altcoin. And the advantage of that is that you could potentially prevent a collapse and at the same time make significant amount of revenue while doing it. In this case, my project is at 10% of the profit of that is generated from the market making, but the project keep 90% of those profits. So I feel that it's a pretty good use case of having a large treasury, as opposed to using an external market makers that might be an investors, but their intention is to make money for their own investors. Often market makers bleed the project out and the project don't always understand how it's done, but they're not there to make your project a success necessarily. Their incentive is to make money for their own investors. So if they can make more money crashing your project, they will. And unless it's in the contract that they can, but even then there's so much scam going on with this that it's very scary, I would say, to do market making externally. It's better if you tackle this internally inside of your project and you keep most of the profit of doing it, because that can feed back into your tokenomics and or just operational cost to maintain the company for financial sustainability forever, for many years or decades or and so on.
But what would happen, for example, if so they have released the tokens and everything goes well, demand goes up, and then there's one buyer that decided to invest like a huge amount. So how it would affect the token itself?
A lot of project, like there's different methodology to do that, but sometimes you prevent any single users to have more than 5% of your supply as a way to force a bit more decentralization. Because I think if you have like early stage investors that own 20% of your supply, if they decide that they sell everything, they could significantly hurt your project because your liquidity pool is often way too small compared to what's in circulation. So it's at that point, it's like a bank that suffer a bank run. So I probably should explain what is a bank run to some of our viewers. But when everybody go to the bank to withdraw their money all at once, the bank don't have amount of money there. So Silicon Valley Bank and a bunch of other banks just, was it a year ago?
Yeah, it was a year ago, actually. It was a year ago. Because I remember when I was at the company I was working before, they had this like kind of a collapse moment, but they managed to take out the money before it happened. But it's all about the fractional banks that, yes, they do have some certain money, but they don't have all the amounts that actually people put in the bank because they use those money with other things to gain more revenue. So that's the scariest part of the banks.
So the thing, so if it can happen to banks, the same thing happened to crypto project all the time. And it's saying that typically speaking, you have a certain amount of money on a liquidity pool on a decentralized exchange, and that's acting as a bank to a certain extent. So if people sell for $2 million of token, but there's only 50K in that liquidity pool, that's the price become exponentially low too, because it never goes to zero on a bonding curve, but it can get exponentially low, and that's a bank run. And kind of the same thing can happen on a centralized exchange. If the market makers stop matching buying and sell orders, then it's up to the market to have this happening. But sometimes if everybody trying to sell and there's no buyers, that's equivalent to because the price will collapse at that point.
But don't you think in the future, like for the bank run within the blockchain part, there is some moments to prevent that, no?
That's why a lot of projects do staking and long-term staking. This way the tokens are not available to sell. But no, a bank run is always an issue because typically speaking, and you can read some of my blog post on Medium if you search for Crypto Rookies, but I go through the math of that. But typically speaking, the liquidity pool are small. So when people buy for $100 of token, the value created for everybody in terms of circulating market cap is increasing more than $100 in total. So there's actually value that is imaginary. So even though you say that currently my capital is worth $2 million, if people start to sell, or even if you start to sell, it's not what you're gonna get. The chances are because the liquidity pool are often too small. So the price fluctuate faster than what is your actual value, unless you're a tiny amount of token in a very large market like Bitcoin. If you have $1,000 of Bitcoin and you sell, there's the size of that market can absorb it easily, but I think it's not always the case in some of the cryptocurrency that have really small and shallow liquidity pools. So earlier I touched on the challenge of having real users versus speculators. To me, whenever you're doing airdrop or you're doing community reward or your early investors, if they are not real, that's quite risky because those speculators are just there to make money. So it's always a challenge to manage that because they are often in the crypto industry, the vast majority are speculators more than real users. And a lot of projects, I would say, except when it comes to DeFi to a certain extent, because in this case, the speculators are potentially your real users. Because if your only incentive is to make money, but you're a DeFi protocol that help users make money, they might actually be your real users in this case. But if let's say you're a gaming project, your real users would be gamers. So when you are doing community reward, you should try to make sure that it's people who play the game that do something that is more about just speculation. And is this for your early investors? It's better if they were strategic investor or the type of investors that are actually gamers. And the thing, each project is different. I would say that if we're talking about social media industry like Favor, could they actually not advertise to crypto users at all, but try to go get social media users and maybe even hide the crypto aspect of their project? I think they would do much better. And I wish the day of crypto project to try to go like this would happen sooner than later. Okay, a tech company want to sell their product like a LinkedIn subscription. You don't sell a LinkedIn subscription to a speculator. You sell it to your users that want to use it. So if you're giving any sort of token or financial incentive, I would try to separate and segment those two crowd of users so that the speculators don't dump and cause financial trouble to your real users. And that can be done in some cases with staking and some other various mechanism where the profit of your project either go to early stage investors and it maybe they lose that financial incentive if they sell the token. So it could be staking. Let's say that the early investors have to stake and then they have extra revenue share on your project. That's one way to do it. Or the token, don't pre-sell your token at all. Sell equity to investors, like actual equity of the business itself. And then if there's a revenue stream from the real users, take some of that to go give back to your investors. So that there's ways to do this, and I think it's much preferable to make sure that you do it separately. So maybe if it's done through staking, for example, in this case, because the SEC, the rules about what is a security and what is not a security, a lot of it has to do with expectation of profit. So the moment you do a pre-sale with a price that increase, you're breaking that rule, and then you are basically flagged as a unregistered security if you didn't follow the rules of security. One way is that you just follow the rules. It's like the Reg CS and all the stuff about equity crowdfunding. All of those rules are clear and easy to follow. Just most people in crypto are rebels and they don't want to follow the rules, but it can be done. And in which case, then you can be just a pure security on your token and be accepted by them, which is fine. If you don't want to
I have a question. So, for example, if itself the project, they decided, okay, we need some investment and they want to sell the part of the equity. So because I came from the financial world and I'm now entering the financial world into Web3. So I realized it's something not easy like when you do the financial modeling for, let's say, to show the valuation for the investors so that you give a right percentage. So I found it really tricky how you can forecast the token itself, the behavior, the demand. And of course, I know there are some like certain aspects that you account, but it's really hard to see how the trend and how it will go. And maybe there's other ways how you can probably attract investors without maybe financial modeling, because that's the trickiest part to forecast.
Yeah, but I would say the same is true for tech companies before they are pre-revenues. Sometimes investors still invest in them, but the value is based on the market potential and the team. I think it's relatively the same. One thing is for sure is that in crypto, when things succeed, it scales to like the project, like the token market cap gets into the several $billion, often in their first year after launch. Scalability is insane in that industry. So as an investor, if I have a way to get my money back before the token price collapse, and if I can prove as an entrepreneur that my token economy will not collapse, and the whole reason is why I want to sell equity and not tokens early on, yeah, I think personally I would buy it. It's tough for some investors to see it like that, but to me it should be done that way, and it would be a lot safer than security aspect and the equity. Like that's your investors and your speculators to a certain extent. And then your token economy can be purely for your actual users. The other option is that you have a token economy across speculators, but then the speculators have to stake. And then if they don't stake, they don't get the extra profit that is being generated. Because I think your real users, maybe they're not necessarily there to benefit as much financially. And I think if you don't mix those two, and maybe the other option is that you do have some of your users that are both speculators and real users, but they just have to play on both sides, having some token that they use to play the game and some token that they stake to get access to that financial upside. And I think if you do it that way, I would say with no pre-sale, okay, I'm not a lawyer, so don't quote me there, but I would say there would be a way for the token to be considered a utility that is not a security and be SEC compliant. And then only the staking mechanism would be a security per se. So if you avoid the SEC rules, you could say that the staking portion is unavailable to US investors or like non-accredited investors, but then the token itself could be freely used by everybody. And then as market adoption increase from both speculators and real users, the token price will have a bit of upside regardless. But it will not be qualified as a security in this case because the expectation of profit, as long as it's not mentioned, it's not an important reason why people are buying it. So I think it would be the best of both worlds if done that way. I think there's all kinds of ways that you can juggle that to make this happen also.
And that came to my mind of, so when I see that they're gonna release like token, and how they exactly know how many tokens they can unlock.
I think like for a tech company back in the time of MySpace, nobody knew that social media could be the size of Facebook that it is now today. So everybody struggle with market sizing. I would not necessarily try to do it that way. That's why for me, I would prefer an unlimited supply of the token that adjusts with the size of your market. So you have both minting and burning. And if you start scaling, you mint, but you mint always a little bit less than the market demand. And then when the user base start to decrease and the capital start to decrease, you buy back the token and you burn them. This way, you always adjust your supply with the size of your market. I think it's better than having a fixed supply and you don't have a way to manipulate it based on your user base.
You probably have to think about lots of things before like releasing the token itself.
Yeah, and I think I don't really see project doing it the way I described. Most of the time, all of the token release is done predefined from the start. And I think it's a mistake because there's no way they can predict accurately what it's going to be.
Do you think it's because of lack of information or education, or maybe they do it on purpose?
I think it's for simplicity's sake. And I think it did everything fixed from the start and it initiated a pattern in the industry. It's hard to get back to having an open mind because if you're too deep in that industry, you get brainwashed and you just apply the magic formula that other projects in the past have done. You get stuck in the box. But there's no reason why it cannot be done the way I described.
Because it seems like from the tokenomics side, it's the healthier way to be longer and exist longer as a token.
One thing I wanted to mention is that this is a lot of content to absorb, and it took me years with failures along the way to learn what I know now. If you want to really get involved in the crypto industry a bit early on, it's fine, but maybe that's where Cyrator comes in, is that go to the website, which is our partner, which is in the description. The link is there of this video. Go check the project. And there's a section for each project on tokenomics. Me and several other analysts are reviewing tokenomics. And if some of the project we didn't review, eventually that's one of the features that will be coming out at some point, is that you'll be able to ask for a review for tokenomics and even put a bounty for it. So if you're unsure and you want to double check your own analysis, you can get other people that are more advanced to take a look as well. So it's a good platform to to look at tokenomics, but every other aspect of a token project.
Yeah, I think that will be a huge help for people of not only based on your knowledge, but it's an extra knowledge from other people as well. It's like a sharing information between each other.
Yes. So that's a blog post that actually I wrote a while back. If you go to my Medium, it's medium.com, and then we'll put the link in the video description again. But this one was entitled Tokenomics Gone Wrong. And I go over 2 projects specifically and how they did their tokenomics and what was I calculated the thing in their case, they had unlock at TGE and all kinds of stuff like that. So I went over all the mathematics there. And basically, this is one that I said, yeah, this is going to go really badly. So we can take a look now. So the thing I predicted that the price would collapse.
Oh,
Yes, it did. I think the pumps sometimes are good. Let's see. Yeah, what the peak here was price. That's what we were saying earlier, that the price sometimes get minuscule. Yeah, that's probably in that zone. And then, yeah, it collapsed. The other one, the Shiba Original Vision, SOV, I predicted that this one would collapse also. And yeah, so it's not teed. And sometimes I can say that it's going to collapse, but maybe it's going to pump, start to collapse. But if you have a pretty solid understanding of tokenomics, your probability of being right could actually be pretty good, because some tokenomics just don't make any sense. So you can look at that article and read how the tokenomic work, like my calculation, how to evaluate everything. And that should
like calculations with the formulas that you can calculate.
Yeah, exactly.
Wow, that's interesting.
Because I think the bonding curve follow this formula, x times y equal k, where k is a constant. So if you're launching on the decentralized exchange, and you can look at the project, like you can see here, for example. So it was only traded onto MEX, is a centralized exchange. But when I looked at the project, it was only available on a decentralized exchange. So decentralized exchange, like Uniswap, use the bonding curve that I described here. So you can actually calculate a lot of what is the potential selling pressure on after launch, basically.
But can you apply kind of similar projects?
Yeah, that's saying it's a lot of projects follow those pre-sales kind of scenario. And then you can calculate a lot of things like this. When it's a project like Bitcoin that don't have a pre-sale and it's just a mining process or things like that, then you cannot really do what the calculation I'm doing here. But at the same time, if you never pre-sold the project and you launch on day one, and the only way to get token is to buy them, unless something really weird is happening, somehow they start giving free token. If the project is not giving free token or discounted token and everybody had to buy, then it's a lot safer that the project may have a long life cycle, as long as there's market adoption, obviously. But I think that sometimes project launch like that, but that implies that either they bootstrap with their own money to launch the project, or they find investors that buy equity and then don't give free token to your investors, give them a portion of your return, your revenue.
Interesting. And is there a way you can attract more and more people? It's when you think about 5 years within the long term, I think that's pretty hard, no, to keep the demand up or within the flexible curve.
Yeah, but if you're building a product that has value to a certain amount of customers, and you have some way to finance your sales or marketing team, technically speaking, there's no good reason why it would cease to exist. Like most tech product can last several decades. I don't see why crypto projects have to die after 2 or 3 years or 5 years. And been going on for 12 years. Ethereum, I forgot exactly, but it's close to a decade at this point, maybe 8 years. Technically speaking, if it's done properly, it should last. As long as you're solving a real problem a certain amount of people in the world needs to have solved. And the thing, if you don't allocate a portion of token supply to finance that marketing or sales, or like just the maintenance of the technology, just make sure that you have some sort of revenue stream that get collected to finance all of that, those expenses.
Yeah, I think I saw some project. So token itself, it can be connected to something like physical. So is it happening in the real life?
Yeah, there's a few projects that are about decentralized telecom network. So Ator is one that is scaling pretty well right now. So you buy a piece of hardware, and then as a node operator of the hardware, when people basically they buy a subscription to the Wi-Fi network, and that means you as a node operator of the hardware, you collect a percentage of revenue from those subscriptions. So
that's pretty interesting model. Huh?
Yeah, there's other project I've seen was solar panel on a rooftop of houses or buildings, that if you want to go charge your car and like basically hook up on the electrical network of that solar panel, you can pay with cryptocurrencies. And the thing in this case, you're mixing hardware and crypto. There was another project that took those tiny little car in India. So it's an electric tuk-tuk that basically you pay with cryptocurrency. That it's a cryptocurrency design for that specific project. Like real users use the car, but the there's a use case for the cryptocurrency aspect into this. And so it makes sense instead of dealing with cross-border transaction and all kinds of stuff like that. And when it's peer-to-peer, like the solar panel, you could be operating electricity, acting as an electricity provider to people who come charge their car at your house. It's not a bad use case, especially if you have excess capacity, if you have more than your own needs. That's where crypto shine, is when it's peer-to-peer and you cannot trust the other person. Makes sense.
Exactly. Yeah.
It's a big topic. Like in summary, I would say, personally, I prefer tokens that don't have pre-sales. And if you really want to do pre-sale, you have two choices. Either you go full SEC compliance with regulation, and honestly, it's not that bad because the rules are pretty clear. Just follow them. And many jurisdictions have different rules. That's part is annoying. But if you follow the US one, they are the most strict for the most part. Should be good. Or just don't do pre-sale and try to put your token more as some sort of utility. And I think how we test, as there's typically two aspects of it that get broken, is the expectation of profit. So just don't do that. And then the other one is the aspect that if you have a small team, or like it can be a big team too, but if all of the success of the project depend on some easy to spot individual or company, that's bad. So that's why having a decentralization aspect is really good to have, but you need to seize control to a certain extent if you want to achieve that aspect. But it's achievable also with DAOs and stuff like that. But the DAO model is, in terms of governance, is a bit tricky. But the other option is just having enough node operators, like a franchise model, where it would make sense. And it is achievable. So if you do that, then you're a lot safer to be categorized as a utility. And then, yeah, just don't use that to finance your development early on. Just go with normal equity.
Yeah, perfect.
Good. All right. So I think that concludes our session now. The next session, I'm not sure what yet will be the topic, but yeah, we'll figure something out. And it will be tokenomics again, but just another aspect of tokenomics that is important.